This video will help you understand how it is possible that big multinational companies can legally evade tax payments. The total revenue of Fortune 500 companies in 2021 was almost $38 trillion, one-third of the world's GDP. Despite these enormous profits, many of them paid zero or next to nothing in taxes. And guess what? It's absolutely legal. How do they do it, and how is it legal? You see, tax evasion is a serious crime in any country and comes with hefty punishments. Tax evasion robs the nation of revenue, directly affects the living standards of citizens, and worsens the income inequality. Strangely, tax avoidance or tax minimization has all the ill effects of tax evasion, yet it's legal. Corporations use loopholes in tax laws to reduce the tax they have to pay, hence they can pay little or nothing at all. Finding these loopholes takes the workforce of entire accounting departments. Did you know that the US tax laws, for example, would take 2,600 pages to contain them, and the mere size of it means there would be dozens of loopholes to exploit? You see, the adoption of the separate entity principle at the global level in the late 19th, early 20th century made it possible to make subsidiaries of large corporations independent in their own right. These subsidiaries are separate entities that pay taxes in the countries they are located. The principle aimed to allow each country in the supply chain to receive its fair due, but as it often happens, something went wrong along the way. Due to globalization, multinationals have spread their operations to several countries, including developing nations and the so-called tax havens. By sharing profits within the company, their profit has skyrocketed. And not being simpletons, they basically don't pay taxes if there's an option not to pay them. Microsoft, for example, whilst having a global profit margin of 42.3% last year, is using tax avoidance or minimizing tax techniques, as well as many other corporations, and thus its profit margin in Australia, for example, is only 4.5%. Tax avoidance is made possible by exploiting loopholes in the law. These loopholes could be made unintentionally by legislators or deliberately inserted after lobbying campaign by multinationals. The common loopholes include offshoring subsidiaries in tax havens. In the Cayman Islands, for instance, a 5-story building called the Uglan House is home to 40,000 corporate headquarters. Then there's also a loophole known as debt shifting. Corporation tax is a tax on profit, which is what is left over from revenue after costs are deducted. Interest payments on loans are one of the many deductible costs a company can make for corporation tax purposes. So the more debt the company takes on, the more interest it pays and the lower its tax bill. Accelerated depreciation is another one. The tax system is founded on the idea of taxing income, yet, for example, if a company purchases a phone for $1,000 and it loses a tenth of its value each year, then the company should deduct $100 each year for 10 years. That's depreciation. Accelerated depreciation, therefore, allows taking deductions earlier, which can enable companies to defer paying some of their taxes. Most of these loopholes have become common practice and have even gotten names. One of them was the infamous double Irish used by corporations such as Apple, Google, etc. In 2011, Google Ireland recorded a gross profit of more than 9 billion euros. The company was a subsidiary of Google Incorporated and handled all of its advertising in Africa, the Middle East, and in Europe. These ads were run using technologies that were copyrighted to Google Incorporated, and per the separate entity principle, Google Ireland had to pay royalties for them. 7.5 billion euro royalties. Payments went to another Google subsidiary, Google Ireland Holdings. When the additional costs are added, the total expenses were greater than 9 billion euros. If this subtracted from the gross profit and 3.5 million interest is added, Google Ireland made a little bit more than mere 24 million euros in profit. But what happened to that 7.5 billion euro royalties payment? Irish tax laws only require tax payment if the company's business center is within the country. Google Ireland Holdings had its main business address in Bermuda, so it was not taxed. So it was an Irish company, but it was not taxed by Ireland. Also, the US did not tax Google Incorporated because the entire transaction was seen as an intra-company transfer, which is not taxable. The name name Double Irish is obviously sourced in the creation of two Irish companies by a single corporation. And such a tactic obviously exploited the tax haven loophole. Also, since in order to avoid an Irish withholding tax, Google channeled the payments to Bermuda through a subsidiary in the Netherlands, the Dutch sandwich label was born. In 2020, Google claimed it is no longer using the double Irish Dutch sandwich tax loophole. There is another curious case worth mentioning, the Whirlpool v. Commissioner case that got the tax world spinning. Whirlpool was found guilty of using offshore shell companies to earn millions of dollars in profit without paying taxes. The U.S. tax court ruling against Whirlpool would see the home appliance manufacturer pay over $100 million in tax expense. You see, in 2007, the household appliance manufacturer established two subsidiaries in Mexico and in Switzerland. Whirlpool International Mexico manufactured the goods, while Whirlpool Overseas Manufacturing in Luxembourg, which had only one part-time employee, did the inventory. Mexico laws allowed free imports of materials if the goods would be exported to foreign countries. The laws also made the Mexican subsidiary free from taxes because it was not permanently settled in Mexico. Luxembourg also granted the Swiss shell company freedom from tax obligations because it was not permanently settled in Switzerland. Because of the U.S. tax deferral laws, the United States also did not tax Whirlpool for some time. This clever structuring meant the Whirlpool retained almost 100% of its profits. Tax avoidance is a very difficult problem to solve. The international corporate tax system is deeply entrenched in a century-old principle that has been made useless by globalization. Tax avoidance indirectly increases the dependency of developing countries on foreign aid by robbing them of necessary resources. It also aggravates poverty in these countries. To end the problem would take determined international effort and better tax policies that would seek to eliminate the cause rather to treat the symptoms. Thank you so much for watching this episode of On Finance. My name's Ray. Make sure you check out all of our social medias to keep yourself updated, and I'll see you on the next episode. Goodbye.